Look, I've done this for 33 years, and I've seen lots of people say things and get it wrong. So my view is just ignore all that. Turn off, the idea, and I wrote about it in my book, Valuable, years ago. It's now 12-year-old book, and it's as relevant today.
I've got a copy here somewhere.
It's as relevant today as it was then, and that is just turn the noise off, turn the stock market off. Focus on what's important. What's important is buying quality businesses that have a long runway for growth, that might have a tailwind behind them. They're high quality, they've got little debt, they generate great margins, they've got high rates of return on equity, and you'll make a lot of money doing that by not listening to the market, by taking advantage of it. So, so what'll happen, I'll give you a framework that answers your question more specifically. At the beginning of this year, everyone was enthused about the fact that we could get 3 rate cuts this year, right? The Fed was talking about that. Jerome Powell talked about it. And it was mentioned at the RBA as well, that we could see cuts towards the end of the year. So then what happens is the market gets excited and prices start to go up, right? Do you get excited and jump on that? Could they be right? Most people are probably wrong. So what you do is you say, prices are now expensive, or more expensive than they were. I'm going to be disciplined about the prices that I pay. I'll wait for the market to be disappointed. Then what happens is, hey, we're not going to raise rates. We're not going to cut rates 3 times this year. It looks like it might only be once, or it might only be twice. Market gets disappointed. Market sells off. Guess what? Now you're zigging when everyone else is zagging. Now you say, okay, now I can buy these high quality businesses cheaper than they were 3 months ago. Now I'm going to buy them. Because what will happen is people will work out rates will only be cut once, but it actually doesn't matter whether they're cut once, twice, 3 times. That's not why we're investing. We're investing in this business because it's growing its profits at 35% per annum. It's got a 75% margin, and it all drops to the bottom line, and shareholders get all of those rewards. And if because rates are only going to be cut once, the PE contracts, the price to earnings multiple goes from 35 to 25, ship it in. I'll buy heaps of that. And guess what? Because I know within the next 5 years, the PE will go back up to 35 for some reason. Somebody that the market doesn't like resigns, and then everyone gets excited again. And as I said right at the start, I've been around 33 years. I've seen the market get excited, gets disappointed, and as sure as night follows day or day follows night, it'll get excited again. So buy when the market isn't excited, buy when the market's disappointed, buy quality, and then just hang on and wait for the market to be excited again. Don't worry about whether the rates are going to be cut 3 times or once. If it's only cut once and the market's disappointed, that's a gift.
Love it.
Bryce is going to have to find something else to do with his spare time rather than watching the RBA.
Hey, look, I write about it too. I'm commenting all the time, but the background is that it's noise.
Yeah.
It's noise, and it's potentially a distraction. But I'm writing about it in the context, in our blog and in the Australian, I'm writing about it in the context of taking advantage of it. Benjamin Graham once said, it's not the market's wisdom that you want to focus on, it's its wallet, right? You want to take advantage of its depression, not get sucked in by its optimism.